Hey there, folks. This is Deeksha Janiani representing Team Trendline. So, as we are in a new earnings season, investors will want to know which are the sectors that are going to outperform in Q1 FY23. So, this week we discuss the sectors and companies which might do well and which might not do well according to analyst expectations in Q1 FY23 and FY23. These results have been derived from Trendline's forecaster-based screeners, which are in turn based on consensus estimate of analysts, and the link for these screeners are given in the description box below. So first up, let's find out which are the companies that are going to see the highest rise in their revenues on a year-on-year basis in this quarter. So fashion and footwear retailers like Trent and Bata are likely to see their revenues jump 3 times year-on-year in this quarter, backed by not just a low base of Q1 FY22 but also healthy customer footfalls. So the apparel and footwear retailers saw their revenues grow in double digits for over the pre-COVID era for each of the 3 months in Q1 FY23, according to a survey by Retailers Association of India. Even Phoenix Mills saw the like-to-like consumption expenditure across its malls grow 9% over the pre-COVID levels. So shoppers are definitely thronging the stores in huge numbers, which is likely to benefit the retailers and mall owners. So before we dig deeper into other sectors, let's understand some key trends. So the prices of base metals like steel, aluminium, and copper have corrected over 30% from the start of April 2022. For instance, steel prices has declined 40% year on year in July 2022 owing to weak demand from the Chinese economy, which is the largest consumer of steel products. And this trend, along with the imposition of export duties by the Indian government, also hit the Indian steel markets. The current prices of hot rolled coil in India is 62,000 rupees per ton, which is down 26% from the May 2022 levels. Yes, that's right. Now, copper prices also hit a 17-month low on the London Metal Exchange back on July 5, owing to a fear of recession in the US and China. LME aluminum prices also followed suit and corrected 34% in just 4 months. However, if you look at the overall trend of aluminum prices, they have corrected the least amongst other metals on a year-on-year basis in July. So, see, of course, the sectors which will be benefited by these trends are the heavy user industries like automobile, auto ancillaries, consumer durables, and real estate sector. Accordingly, the indices for these sectors have outperformed the Nifty 50 by 7 percentage points or more in the last 1 month. So let us take up these sectors one by one. So first is the automobile sector. So, first we will discuss the wholesales data for the auto majors, which is already out, before we move on to the analyst estimates for the same. So, four-wheeler makers managed the wholesales for four-wheeler makers actually crossed the pre-COVID levels in Q1 FY23. However, the wholesales of two-wheeler makers like Hero and Bajaj Auto was only around 75% of the pre-COVID levels. However, there is a silver lining here because Hero Motocorp and TVS Motors still managed to clock a growth of 35% plus on a year-on-year basis. Now, the four-wheeler makers actually saw a good recovery across their passenger vehicle and commercial vehicle segment. However, Tata Motors is still, is yet to recover fully on the commercial side. If you notice a player like Mahindra and Mahindra, it clocked 25% plus growth in both passenger vehicle and commercial vehicle segments. And so the growth on it of its passenger vehicle segment is driven by its new launches on the SUV side, which is Thar and XUV 700. So the one point to note here is that only Maruti and Mahindra feature in our screeners, but we wanted you to get a broader sense of the trends that are being observed for original equipment manufacturers, because a healthy volume recovery for OEMs also means that the growth will be healthy for the auto ancillary players. Yes, that's right. So the healthy volume trends that we have noticed for this quarter will continue for FY23 as well, backed by a normal monsoon season and a healthy festive season. The margins of these auto players are also likely to improve from the next quarter onwards, backed by the correction in metal prices. However, the passenger vehicle market leader, which is Maruti Suzuki, clearly stands out here. The company is planning to launch 4 new brands of SUVs in the next 2 years, and it's also likely to upgrade many of its existing models, according to Motilal Oswal. It has not launched any major brands in the last 3 years. So it's no surprise that analysts are expecting this auto major to double its revenues in FY23. Yes, that's right. So moving on to the consumer durable sector. So the margins of consumer durable players were actually compressed in FY22 owing to the simmering metal prices. The market leader, which is Havells India, actually saw its EBITDA margins contract 3 percentage points in just 1 year in FY22. It actually clocked a net profit growth of only 14.5% in FY22, despite clocking a revenue growth of 30% plus because of this margin contraction. Cut to March 2022, a intense heat wave had hit India. So, manufacturers of cooling products like ACs, coolers, and fans saw the perfect opportunity. In fact, the according to a industry body, 6 million units of ACs have been sold in India in the first half of 2022, up 30% from the first half of 2019. So, looking at these healthy volume trends in April and May, analyst estimates these companies to clock a revenue growth of at least 50% in the first quarter of FY23. The margins of these players are also set to improve. However, the rupee has depreciated against the dollar by 9% year on year in July. So that can act as a counter on the anticipated uptick in their margins. So because see, AC companies actually, for AC companies, 60% of their components are actually imported according to Godrej compliances. That is why this depreciation will affect them. Now, the uh, correction in copper prices will also benefit your cable and wire makers, because see, for say KEI Industries, 35% of their raw material cost consists of copper. So definitely these players are also going to see a margin improvement from next quarter onwards. So let's move on to another sector. So chemical sector is also likely to continue its strong growth trajectory in this year. So Tata Chemicals saw a 9% quarter on quarter price rise for its key product, which is soda ash. Soda ash is also seeing good incremental demand from its newer applications in lithium carbonate batteries and solar panels. And see, no new capacity addition is being done by China, and there is a robust demand for this product. So the pricing environment will also stay very buoyant for soda ash. For specialty chemical players like SRF and alkyl amines, they are seeing very good demand from user industries like agrochemicals and pharmaceuticals. Moving on to another player, which is Vinati Organics. This company manufactures a kind of sulfonic acid which is called ATBS, and it's expanding the capacity for this product by 50% to 60,000 metric tons in the next 6 months. So this is going to drive the growth for this company. Next up is Anupam Rasayan, which clearly stands out in the order of things because it's going to clock 60% plus earnings growth in this year, because see, agrochemical companies are witnessing strong domestic demand, backed by a normal southwest monsoon in India. So that's the thing working for them. So moving on, see, if you have noticed the early trends of results in the IT industry, mid-tier IT companies like Mindtree, L&T Technology Services have clearly, outperformed the larger peers like TCS and HCL Technologies in terms of quarter-on-quarter revenue growth. They have also sustained their margins despite higher employee cost and travel cost. So these companies are getting the benefit. So these companies are basically getting the benefit of shorter duration deals, and particularly in the 10 million US dollar segment. So accordingly, analysts expect persistent system and emphasis to clock over 21% revenue growth in this year. Meanwhile, companies which are offering their communication platform as a service, like Tanla platforms and Root Mobile, will also clock healthy growth, backed by rising user messaging traffic on their platforms. Other than these, InfoEdge, the growth for InfoEdge will be driven by its recruitment management platform, which is Naukri.com. There is a strong hiring intent across industries like banking, you have IT, and you have travel, etc. So that is going to drive for the growth for this division. Now, moving on, see, we are clearly seeing the recent trends in metal prices. So, one sector which will clearly fall out of favor is the metals and mining sector. So, the margins of steel companies, iron ore companies is likely to revert to their mean levels, backed by lower realization and elevated level of input cost. So that's one thing. And if so there is one more thing here, that even the cement sector is going to fall out of favor because of the elevated coking coal and imported coal costs. So that is also likely to negatively impact the earnings of the cement sector in FY23. So I hope, folks, that you got some interesting insights about the sector that are going to be star sectors and the sectors which are going to post weak performance in this year. So that was my time, folks. Thank you so very much and have a great day.